If you can imagine the resource sector as a snow globe, Russia just shook it. You're listening to Kitco Roundtable. I'm your host, Michael McCrae. Kitco correspondent Paul Harris is in. Hi, Paul.
Hey, Michael, how are you?
And with us is the founder and CEO of Triple Flag Precious Metals. It is Shaun Usmar. Shaun, how are you?
I'm good. Hey, thanks, Michael. Good to be here.
Shaun has worked for some of the biggest mining companies, and he's seen a lot of the industry, and we really want to get his thoughts on everything that is happening right now. We're going to be talking about macro, we're going to be talking about gold, but before we do, I know that most of you were at the BMO show that we held. Paul, Paul, I'm going to start with you and then I'll go to Shaun. What were some of the highlights at BMO down in Florida?
I think that the first one, first and foremost, is being able to see so many people in such a short space of time. You know, for most people, it was, let's say, 2 years since last had the opportunity to meet, shake hands, pass each other in the corridor, catch up on news. So that was absolutely wonderful. And it was unfortunate that this happened as Russia invaded Ukraine. But obviously the metals price environment, because of that, was very, very buoyant. And so lots of things to talk about on multiple levels.
Shaun, I could imagine you're probably checking your phone or whatever device you're looking at and then seeing metal prices do all of this news at the same time you're taking your meetings in Florida.
Yeah, it's, I share Paul's point. I mean, I think the energy of being at really the first mining conference since the pandemic is sort of self-fulfilling. It's just those chance encounters and people you hadn't seen in so long that happens outside of like a virtual meeting schedule. So it was super busy. But in the meantime, as you say, you've got this sort of tragedy playing out in Ukraine. You've got these whipsaws on commodity prices, and it's a really unusual environment.
Gold and silver markets are remaining supported by the tragedy in Ukraine. It's really been a safe haven demand amid arguably the biggest geopolitical crisis in the past 30 years. As of recording, spot gold is well above $1,950 an ounce. Bitcoin is just over $40,000. Gold was about Gold was just under $1,800 a month ago, just to show you how long ago that was. Jobs report was out, which was much stronger than expected. U.S. job growth surged in February, pushing the unemployment rate to a two-year low of 3.8%. Averagely hourly earnings flat, up 5.1% year on year. The data should give the Fed confidence to tighten. Shaun, it's really been an interesting 2 weeks for gold. I was really surprised at how strongly gold performed with this, with this geopolitical earthquake that we had. Bitcoin, interestingly, underwhelmed and sold off when the news broke about a week ago. Your thoughts on what we've seen out of gold for, I guess, probably the last fortnight, Shaun?
Yeah, look, firstly, gold is, even in 20, even though it underperformed, the Fed started their tightening rhetoric some time ago, and equities in particular underperformed as inflation went from transient to, being obviously a more permanent fixture. But I think all that rhetoric around Bitcoin and crypto being a sort of new store of digital gold and digital currency, I think is sort of being revealed. But in a moment like this, gold really does have that safe haven status. And it does feel to me that there's a lot more as this situation unfolds for it to go. There was an article on Bloomberg this morning as well, also pointing to silver, which outperformed gold in 20, and saying that, it's underperformed recently with silver. And so there's perhaps opportunity to see silver do very well in the coming months. But I think I'm constructive on both in this environment.
We're going to have a discussion further, but I think we should bring it out now since you mentioned it, Shaun. You're mentioning that you really see that inflation should be more of a lock-in right now. When you're looking at financials, when you're talking to their miners, what do you see right now? Why do you think that inflation is going to be locked in here?
Six months ago, when we were talking to some of our portfolio business partners, it really seemed to be quite regional. We would see inflation more in wages and that in areas perhaps like Western Australia. We saw signs of it in Brazil, although currency offsets. But as we hit this earnings cycle, we've seen it creeping in quite significantly, I think, with all the issuers and all those who were reporting. My concern is that was before a crisis. And, we've got this really crazy environment where with the pandemic, the supply chain disruptions that we've seen, the excessive stimulus perhaps that's really fueled some of those employment numbers or unemployment numbers that you've mentioned. Now you throw this in, and I think we're in for not just permanent inflation for some time, but also really quite significant dislocations. I was looking today, even coffee inventories at 22-year lows. And, you look at Ukraine and and Russia's wheat supply, 30%. I mean, that's a real problem, I think, for food inflation. Food inflation, I think, was nearly 8% in January before this crisis. So I think we're going to see some numbers here that we haven't seen in a very, very long time.
Paul?
And to add to Shaun's point, I think in addition to food itself, Russia, Ukraine are also important producers of key fertilizer elements. So it's not just the grain they do produce, but it's how their products help produce food around the world. But the point I wanted to make, Michael, was that at BMO, I spoke with a lot of project developers, and the timing of inflation is going to be critically important. The message coming through was that if you're looking to buy a plant in a year's time, 12 months out, you could be likely to experience a 50 to 100% cost increase. If you can go forward to 18, 24 months out, that starts to come back to sort of more normal pricing levels.
Shaun?
Yeah, we've seen quite a lot of investment even the last year on single asset development companies in particular, which have a distinct risk profile in the mining space, as we all know. And I think for the longest time now, we've been concerned just because of COVID about supply chain disruption, long lead items, people who don't have what they need at site, having to sort of keep the skills there, and obviously the sort of cash drain that implies for those businesses. So it's been an acute diligence focus for us for some time, and I think this just takes it up to a whole new level. It's going to be a really interesting thing as we need new supply. And the supply side really struggles to meet demand at the moment.
Shaun, how fundamentally are the economics changing for, say, that you have mines that you can develop in, countries where you might be on the grid, especially you can be on a clean grid? Because we saw the M&A action that was happening in 2021, and that was like touted mostly what we saw with the Agnico and the Kirkland tie-up, just talking about being on the clean energy. You see that again and again as far as people that are marketing their projects in northern British Columbia and up in the Yukon as well.
Sorry, Michael, can you repeat the beginning of that?
Okay. I just was just the economics of projects right now. I'm just wondering if they're going to be changing fundamentally for if you could be actually on electricity grid versus that you're going to be powered by, you're going to be powered by either dirty coal or you're just going to have a diesel project. I mean, these must be changing quite fundamentally.
Yeah, it's a great question because I think of when I was in the nickel business, regions like Raglan up in the Canadian subarctic, you're totally dependent on diesel or Arctic diesel essentially for power generation. There's some wind generation there now, but really you don't have those choices. And there's so much remote generation that is dependent still on fossil fuels that I think the impact on that on cost structures, I think you look in Europe, you see what's happened with aluminum refineries or smelters. They've had to curtail production on the back of rising energy costs. And I suspect we could see some more of that, which would add to sort of the supply situation in the coming months. But I was looking to today in the Financial Times, I think they were talking about energy prices hitting over 200 euros a megawatt hour and coal going to over $400 a ton. So there's some really big numbers starting to emerge with this conflict.
I see your point, Paul, but just to add on to your point, Shaun, Sibanye-Stillwater with its year-end that came out, it really flagged as a concern the mines that are tied to the electricity grid with Eskom and South Africa. So you have an unreliable grid. You also have something that is very much counting on fossil fuels for driving it. So this just becomes a concern because if you're somebody like Sibanye, which is supplying catalytic converters in the PGM and then playing into that space, you're tied to this grid. It's expensive and it's both unreliable and it's just not going to kind of get you to your green goals. Paul?
Another factor playing into this, given that we're in an inflationary environment, we're seeing companies that are developing projects that they're starting to report cost overruns, sometimes considerably, and their share prices are getting hammered. Companies that are producing their feasibility studies, they've got significant cost price escalation, their share prices are getting hammered. So that means it's going to be more challenging to raise the finance to advance projects, which presumably means projects aren't going to come through as quickly, and not all the projects in the pipeline are going to come through for that reason. So again, that's going to exacerbate any supply shortages out there.
Shaun?
Yeah, it's interesting your point you raised about Spain and the potential impact on supply, but then you overlay this Russian situation at the moment, and I think they account for over 35% of palladium supply, for example. So, what does that mean for the auto industry as you start looking at the burrito of metals, in particular, that they supply to the global supply chain?
It was interesting talking to Neil Froneman, the CEO of Sibanye. Because he's you would think that they would be in the cat seat just regarding palladium, because just the way it spiked, and palladium being, of course, such an important part of automobiles. But he was just looking that there's just going to be so much supply disruption. You look at also, which I didn't know, where Ukraine has been an important manufacturer of some parts of key cars. So, they just might be able to produce enough cars right now, as the supply chain is still thrown up in the air right now. So they might not actually be able to take advantage of this palladium, because they're just not by the demand there.
Well, and that's on the back of a chip supply shortage recently as well. So these are compounding supply impacts that I think we're seeing.
Just to put a pin on macro, it should just bear noting, because a lot of commodities broke records. Palladium prices reached $2,750 an ounce. Newcastle thermal coal futures surged to a record $440 a ton. Aluminum hit a record of $3,741 a ton. Uranium jumped over $50 a pound. Zinc broke $4,000 a ton for the first time in 15 years, while nickel reached the highest level in 10 years. Those numbers put together by BMO Paul.
And as we speak, copper's hit $4.84 a pound, equaling its all-time record.
Paul, take us back to mining here. Can you kick us off with the aforementioned copper and phyllo, please?
Absolutely. A couple of big news items this week, surprisingly few considering that it was the BMO Metals and Mining Conference, but big news out this week. Philo Mining said diversified miner BHP will invest 100 million Canadian dollars into the company to advance the Filo del Sol copper gold project in San Juan in Argentina. BHP will buy 6.3 million shares at a 12% premium to own about 5% of the junior. This is BHP's first step into Argentina for many years, and is perhaps a portent of things to come as big companies look around for new copper supply. Sticking with copper, Foreign Mining announced a feasibility study on its expanded and rescoped McIlvenna Bay polymetallic project in Saskatchewan in Canada. The 4,200 tonnes per day operation will produce an average of 38.8 million pounds of copper, 63.6 million pounds of zinc, 20,000 ounces of gold, and 480,000 ounces of silver over the first 15 years of its mine life, following an initial capital cost of $368 million Canadian. This will yield an after-tax internal rate of return of 22%, increasing to 38% at spot prices. Elsewhere in the industry this week, the study woe continues for the silver sector, as Vizsla Silver had to restate its maiden mineral resource estimate for the Panuco silver gold project in Sinaloa, Mexico, after admitting errors in the silver equivalent calculation, which lifted lower grade zones above the cutoff grade. This saw the stock dump more than 10% on the day, and follows another recent big foobar from Gato Silver relating to resources. Panuco has an indicated resource of 5 million tonnes, grading 383 grams per tonne silver equivalent, containing more than 30 million ounces of silver. And as for in a bid for maximising clarity, the company reported its base metals as kilotons rather than the normal parlance of 1,000 tonnes. Other big news this week, time to break out the popcorn, as London-based private equity firm Appian Capital Advisory said it will seek $1.2 billion from South Africa's Sibanye-Stillwater following the latter's termination of the acquisition of nickel and copper mines in Brazil. Sibanye had agreed to buy the Santa Rita nickel and Serrote copper mines, but terminated the transaction in January after Appian informed it of a geotechnical event at Santa Rita. Appian said a crack in the mine's pit wall has no real impact on the open pit's mine life. Sibanye thought otherwise and said it will have a material adverse effect on the business. Appian claims Sibanye's failure is unlawful, and Sibanye obviously rejected the compensation claim and said Appian's claims were superficial and intended to taint the company's image ahead of its 2021 annual results. Appian called this rebuttal false, damaging, and defamatory. This looks like it's got a long, long way to run in the courts. And hedging seems to be coming back into vogue for the gold developers, perhaps relating to some of the issues we've previously talked about today on this podcast. With the opportunity to lock in gold prices above the historically high levels of $1,900 per ounce, project developers are beginning to return to gold hedging to ensure cash flows during construction. Having announced a capex blowout at its Magino development in Ontario in Canada late last year, which saw former president and CEO Pete Doherty fall on his sword, Argonaut Gold hedged 90,000 ounces of production over the next 12 months to provide certainty of cash flow during the final year of Magino's project construction. The company previously reported a 57% cost blowout there, where capex increased to $800 million compared to the initial estimate of about $500 million. And today, Torex Gold Resources is also looking to hedge production as it builds out its Media Luna development in Guerrero in Mexico, where first production is due early in 2024. Torex is currently debt-free and ended 21 with about $400 million in liquidity as it prepares to take on the development, following the completion of a feasibility study, which is due later in the March quarter. Media Luna is due to produce more than 350,000 ounces of gold equivalent a year for more than 10 years, following a $500 million capital investment. Torex previously used hedging in 2019 and 2020.
Kinross says it's going to suspend Kupol operations in Russia as international sanctions bite against Russia. Kupol is a consequential mine for Kinross, just on the fact that it produces a large percentage of its gold, but also that it produces at a very low level, contributing a lot to the company's net earnings. Bad time for Kinross since the company just bought Great Bear for $1.8 billion in December. Paul?
Kinross kind of shot itself in the foot because as Russia invaded Ukraine, it put out a news release saying there's no impact on us before its share price suddenly fell off a cliff.
That seemed it was an interesting decision, and it sounds like something that is going to be very hard for the company to weather itself through. It would be interesting to see how this get through. Paul?
I want to add on to that. Businesses in different sectors that have exposure to Russia are selling their assets right, left, and centre. Shirley's selling out of its stuff in Russia. The owner of Chelsea Football Club is selling because he doesn't want to be hit by sanctions. So, there could be, as this conflict continues, there could be increasing pressure on Kinross to basically get rid of it.
Yeah. Shaun, I want to bring you back in and just for that discussion about the resource sector and impact upon Russian sanctions. I mean, before Triple Flag, you've had past experience at some of the major miners. What are you seeing? How is this playing out?
Yeah, well, firstly, I think just tacking onto Paul's point, notwithstanding the early comments, you look at the announcement I think they put out, Kinross put out the last day or so, really talking about mothballing, the Russian operations or certainly idling them. When I look at their stock, it does appear that I think it was somewhere around 12 or 13% of their NAV that was, attributable to the Russian supply. And it looks like the markets have essentially priced that down to zero at the moment from what I can see. They had underperformed in the lead up to this, but it does appear that that's priced into their stock at the moment. The thing I'm concerned about at this point, really more just whether it's diversified or base, or certainly, let me start that again. The thing I'm concerned about really is whether it's precious metals companies, diversified or elsewhere. It's just this is coming on the back of an already disrupted supply chain globally. We talked a little bit earlier about shipping dislocations, port congestion at the end of last year in different areas that's persisted. We've seen trucking, impacts with businesses. So I think that and skill shortages in different areas is an acute concern that I think we'll see play out. Now, I was a little concerned listening to the point around hedging once again, because I know one of the projects we were investing in some time ago, when copper was just over $2 and then suddenly it starts flirting with $3, you see boards and management teams talking about locking that in. And if they'd done that, which thankfully they didn't, with the input costs and all those going up, it would have been really in a very difficult place. And so I understand the instinct at times for people to start locking in, and they look at these prices through a historic lens and they feel good about it. But if you're looking at this as a risk management exercise, unless you are somehow protecting those margins and you're pretty sure of your input costs, your capital costs, really this can go the wrong way. I remember when we acquired MIM, just after we'd started Xstrata in 2003, when we first started looking at that situation, that was just on currency. I think the hedge book at the time was $250 million out of the money, the Aussie book. And by the time we closed the deal, it was $250 million in the money. So some of these forces in this kind of environment, I think the attempt or the instinct to try and manage some of those risks can really go the wrong way. And we've talked about tipping points, perhaps with pricing. I don't think the supply side is going to be able to react the way people want. I think that's going to be impacted really through, you're going to see these pricing impacts that could be profound. And my concern in that case is actually the potential for demand destruction, which would be a problem.
Paul?
And just one to add on to Shaun's comment about supply chain disruption. Another piece of news this week, Russia's largest steel maker, Severstal, has announced it's going to suspend, or has suspended, shipment of metals to the European Union due to sanctions against its largest shareholder.
I want to move on from Russia, although it's just been, as I guess, saying, it's just been a huge story. But Shaun, we just have to get some of your thoughts here. I want to look back at 2021 and talk about M&A. What stood out for you in the year?
Well, I think obviously Agnico Kirkland got a lot of headlines, and it did appear to be a combination that created a really high quality business. And I remember looking at some of those assets even in Xstrata years, sorry, not Xstrata, but in Barrick back in 2016 or so, and you think of what they've done to prove up the quality of some of those businesses. I think they've got some good synergies, and you've got a really high quality business that's been created there. So I think that's great to see. The gold space and is just generally still sort of fragmented. So it's going to be interesting to see if the bankers all talk about how busy they are. But our management teams and boards are able to overcome the social issues which often get in the way of sensible combinations to sort of kick off a new round of combinations. Because the thing that troubles me the most for our space, just generally, is relevance from a broader investment perspective. Just we lack the broader investability and scale. And so I think even though people like having their own domain, if the sector can come together, drive better returns for investors, and indeed create greater scale, I think that would be a welcome development at this phase.
When does that push happen, Shaun? So is it happen when precious metal prices are high or precious metal prices are low, or it seems like there's an excuse on either side not to get these deals done?
I'm not sure that generalizations always work there, because I remember I had the joys of coming out of business school in the late 90s and getting involved with Billiton, the BHP Billiton merger, and we had that period even leading into the super cycle where you saw a lot of activity on combinations happening around that time. So often you have these sort of forced marriages where maybe cash-rich companies with others who have got stressed balance sheets come together at a certain point in the cycle. I think in periods like this, particularly if you've got businesses looking for growth, and I think we saw it last year with Matsa and Sandfire. There's a good example, although it's not M&A, but acquisition, where a business that clearly needed to, create a future and grow, did so. And I think you may see examples where businesses have got significant amounts of cash and firepower. Balance sheets are generally in good shape, looking for future growth opportunities, and also the ability to ensure that they are robust and can enhance quality and have some decent diversification. So I'm hopeful that at this point in the cycle, you may see more of that. I also think we should be getting close at some point to some sort of generational shift in management, because we need new talent coming into this space. And I think, certainly there is a need for turnover within the sector, and that could also be a catalyst for some of the combinations within management teams.
Paul?
Well, one of the other themes I sort of picked up on at BMO is that investors are starting to ease up on their capital discipline mantra and starting to increasingly embrace the possibility of inorganic growth again.
Shaun, let's close and talk about the company that you founded, Triple Flag. In another conversation, I remember you saying that scale matters. You did have that big financing, I recall, a couple of, maybe it was over 2 years ago, I don't recall. But anyway, talking about scale, Shaun.
Yeah, you recall, Michael, from that conversation, we really emerged from scratch with an idea that the mining sector and more conventional forms of funding really weren't prevalent, particularly at times when the sector needed it. And I think alternative funding, certainly private equity, being able to service single asset businesses, intermediates, whether it's acquisition financing, the next generation of projects, really seemed like a great opportunity to grow the pie, to expand the pie. I think when we started, there was this sort of mindset that it was a fixed mindset. So new entrants are going to struggle to compete with the very well-established and impressive businesses like Franco and Wheaton, for example. But we have found a very consistent cadence and opportunity set in a much larger opportunity set where there's a lot of things that just, you've got to say no a lot to find the good opportunities. The core of that is scale. And we chose out the gate, thanks to the backing of Elliott, who now think of about 50 billion AUM. That allowed us to write those checks that you've alluded to, the sort of 250 million. That was the first. The one you're talking about was North Parks at about 550 million. And we viewed if we could commit about $1 billion to the space in about a 5-year timeframe, that would be the transition to go public, to then really broaden the ownership base and have that critical mass to continue to play in the arena that we saw most of the really high quality opportunities, which has been 1 to 500 million. I'd say it's actually to the month that we've made that transition. Back in May of last year, we actually deployed $1.7 billion over that period. But the one key feature, I think, is that the markets continue to migrate. And I think it's an area that, when I look at the intermediates, is this question of what is the scale that's needed, not just to compete for opportunities out there, but candidly to be relevant and grab the attention of the investors out there. Because I think you see the minute there's an renewed interest in gold or precious metals, it's the larger, more liquid names that get the preferential benefit of that early on, before perhaps you see some of the cascading down the line. So I'm hopeful that in the coming year or more, that this could be an opportunity for us to see sort of greater consolidation and indeed increased scale across the space, both through organic growth, because I think there's a significant amount of ongoing opportunity, as we've seen the last 5 years, but perhaps through sensible combinations in this space as well.
For the royalty and streaming companies, is there a chance for them to grow, Shaun, where you look at talking again about getting new people into the space and then also getting the interest? I'm sorry, I mean, when we looked at the way that crypto took off, the fact is that there just seems to be more fascination or more interest with the markets in that space as opposed to like the precious metal side. So if you're losing investor interest, if you're losing people that are kind of paying attention to the space, is it is it organizations like yourself who are specialists and who understand it? Are they going to be picking up more of the financing and more of the investment and then backing these ventures?
I think we have to. I think there's a phenomenon that we've all lived through, though, in the last couple of years. Meme stocks, crypto, where people have had more cash. There's a sense of community that I think people have been wanting to belong to over that period. And you've seen a flood of interest and investment. I mean, we go to BMO, we see some hundreds of people, many that we've seen many times over in the sector, But you see these crypto conferences, and it's like Burning Man or something. There seems to be a ton of people, and obviously a lot of community around that. So I think those are two very different things. I think in this sort of environment right now, as a sector, we have to find ways to have broader appeal to generalist investors. I wonder in this environment if this may not be the start of exactly that. But scale is an important feature of that. We had a very important investor of ours out of the US recently make the case where they brought one of their generalist investors in to want to understand our story better. This was a specialist. And he made the point and said, look, if they're looking to reposition some of their funds out of, say, Apple, which at the time was nearly 3 trillion, and they wanted to take a more defensive position with some of those funds in the gold space, and Newmont's the biggest name at the time, I don't know, 45 billion or so, that doesn't create, an abundance of opportunity. So if ever there was a case for, more scale, more relevance, consolidation, I think it's a very important opportunity that hopefully the sector can come to grips with.
Let's turn to our number of the week. Shaun, we always start with the guest. You first.
Yeah, thanks. My number is 50. And that's just how long ago it was, 50 years ago, when we last saw such a large weekly rise in commodity prices. I just saw today it's the largest weekly rise in the S&P GSCI on record. And we've seen this sort of steady and strong commodity price increase from the initial pandemic shock, which was sort of Q2, until recently. I think the Bloomberg Commodity Spot Index went from, I think it was about 60 when we were in the bottom around about Q2 of 2020, to hit about 110, and that's really just at the start of this crisis. So, yeah, we're seeing numbers that I'm 52. I haven't seen these in my lifetime, realistically, for some of these moves.
Paul?
Well, I've got two. I'm going to start with a breaking news one. $4.85 per pound copper, a new record in the copper price. That's just coming in as we're speaking. But my pre-arranged number was $17 million US. And that's how much Marimaca Copper is getting for selling its Ivan SXEW plant in Chile. So it seems not even in name, companies are distancing themselves from the Russian pry in every way they can.
I have a green number that's 1 million tons per annum, 1 million tons per annum. Yesterday, Tenova announced that a contract had been signed for a 1 million tons per annum hydrogen-based direct reduced iron facility that is going to be used by Energeon. What's interesting about this is that the plant is going to be installed at Bao Steel in China, which will be China's largest, which hitherto had probably stayed out of this type of technology. The plant will initially blend coke oven gas, natural gas, and hydrogen with the aim of raising the proportion of the latter over time. So you see a significant investment in the decarbonization of making iron and making steel rather from iron ore. That's it for us. Shaun, any news from Triple Flag that we should keep eye on over the next year or 12 months?
We'll come out with our guidance in the next week or so. And then I think it's, we've had a 26% cumulative annual growth rate over the last 5 years in ounces. There's more to come within the portfolio, which is fully funded. And we're very busy on the deal front. So I'm excited about what lies ahead this year.
Follow me at Michael McCrae. McCrae is with 2 C's on Twitter. Paul, how can they get a hold of you?
It's CGS 2022.
And you have something to announce coming up shortly, Paul?
Yes, we have our first CGS conference in Quito in Ecuador on the 6th and 7th of June, focusing on copper and gold projects in Ecuador.
Shaun, how would you like people to get a hold of you?
Really through our website or LinkedIn. Those are usually the sort of easiest channels. So we're accessible.
If you like what you hear, tell a friend. Don't forget to subscribe. On behalf of Paul Harris, Shaun Usmar, and myself, have a pleasant weekend.